This chart shows the federal funds rate alongside the 10-year Treasury note rate. The gray lines represent recessions. For real estate transactions, the federal funds rate directly affects ARM rates paid on most commercial and some high-tier residential mortgages, whether or not they're being originated now or they already exist. In contrast, the 10-year T-note prompts moves for FRM rates. In the short term, real estate agents can expect FRM rates to slip in 2023 as the Fed funds rate increases to knock down excess inflation before the recession sets in. But mortgage interest rates will rise gradually over the next 2 decades, causing buyer purchasing power to decline, unlike the decades prior to 2013. With less money available to borrowers, expect downward pressure on all property sales and prices, until sellers of real estate adjust their listing prices to offset the value-taxing force of rising interest. This chart displays mortgage insurance premiums, MIPs, set by the Federal Housing Administration, and private mortgage insurance, PMI, available from private insurers. As of April 2023, the FHA mortgage MIP rate for a 3.5% down payment mortgage decreased to 0.55, while the PMI rate for a similar mortgage with a 5% down payment remains at 0.68. While you see that FHA-insured mortgage default insurance is less expensive, there's a critical distinction. MIP for mortgages originated with less than a 10% down payment may not be canceled. In contrast, PMI may be canceled once the homeowner achieves 20% equity. In today's era of rising interest rates, refinancing to remove MIP is unreasonably expensive for owners. First-time homebuyers, when acting prudently, will wait until prices bottom, expected to occur around 2025. In the meantime, they need to save up for a down payment to eliminate mortgage insurance and expand their purchasing power. This chart shows the values and returns of real estate investment trusts, REITs. REIT shares were indexed at 8,800 in April 2023, 16% below the index figure of a year earlier. Like property values, REIT values plunged after long-term capitalization rates increased following the pandemic-era economy. REIT values are now roughly level with the values reached before the pandemic disruption. Further adjustments are in store through 2025. The long-term outlook for REITs will find support from the strength of the multifamily and industrial sector, not city center commercial properties. But REIT investors have become cautious in 2023 as the real estate recession dramatically reshapes the commercial market. The past 18 months of deceleration in job growth forecasts more business closings and rising commercial vacancies. To regain stability, REITs need an economic recovery to begin, likely around 2026.